Happy National Investing Day, everyone. Here at Schwab, we believe investing is for everyone, no matter where you're starting from or where you are in your journey. That belief goes all the way back to May 1st, 1975, when the SEC first eliminated fixed commission rates, and our founder, Chuck Schwab, seized the moment to create a brokerage built around democratizing investing for the everyday person. Now, this is our second year of celebrating National Investing Day, and that spirit carries forward. So, this session, our second session of the day, will be Wealth Management 101, and it is designed to give you the clarity and the confidence to take that first step towards building lasting financial security. I believe this, and I know that my co-host does. Investors trade, traders invest, so let's get you started. My name is Joe Mazzola, and I am the head derivatives and trading strategist here at Charles Schwab. And joining me, I'm very excited to welcome Brian Olson, Managing Director and President of Schwab Wealth Advisory. Brian, welcome. A couple things, maybe give some of your thoughts on National Investing Day, what it means to you, your background, and what you and your team do for our clients.
Awesome. Thank you, Joe. Thanks for having me. Welcome, everybody. Yeah, National Investor Day has a deep and personal meaning to me. Way before I ever thought I would work for this company, I started investing when I was in my early 20s, which was a long time ago. And I found Schwab because of the great value they offered. And what back then was the democratization, even continued from 1975 until that, which was the late 80s. And I found this great company that had access to research and resources, which I look back then, what we have now, it's amazing the progress we've made, but offered great value on the trading. And so that's how I found them. Back then, I didn't even know that there was a man named Charles Schwab. Little did I know that, 12 years later, I would actually work for the company. And my career, which I will talk about here in a minute, I had a little stint as a researcher, and I got to help Charles Schwab, the man, who we all refer to as Chuck around here, work on one of his books and research it. And I have never met somebody who has such foresight and such passion for helping individual investors invest. So
Yeah.
Whether you know the history or not, that day was a seminal day for this industry, obviously for this company, for me, and what it meant for generations to come. And I think we're just getting started in the access we provide to research, materials, trading, value. So anyway, it has a lot of meaning to me personally, and I hope everybody can appreciate what he as an individual and hopefully what we as a company have contributed to building wealth for investors around the world. So for me personally, I started on the investing side, a career before I came to Schwab, a little stint in operations, a little stint in trading. Came to Schwab, as I mentioned, as a researcher, helping build out some of the asset allocation, stock selection, security selection tools we had. Went on to manage a couple companies that were investment management companies owned by Schwab, stint as a portfolio manager. And then I think what got me invited to this is I made the transition to wealth management. And there's a reason I did that, and I'll share some of that as we go along here as part of the story. But I always felt like investment management was great, and I was helping people, and getting that extra 10, 20 basis points of return was important, but I never got to see sort of the end outcome of that. And I had the opportunity to do a few client events and see clients and hear that feedback of the deep meaning we had when we could help them beyond just investing. And we'll talk about wealth management and what it means. And there's many components beyond just investing, which many people think that's what it is, but it's well beyond that. And when I started to see the impact that we could have on someone's life when we look at that whole interconnected ecosystem of not just investing, but all of the elements around that we call wealth management. Again, we'll obviously talk about some of those. So that's sort of what National Investing Day means to me, and sort of how my career progressed to get to this point and get invited on this show, Joe.
Well, we're glad to have you. And I'm going to do this real quick, Brian, if you don't mind. I'm going to go ahead and go through our disclosures. Material today is meant for educational purposes and informational purposes only. It's not going to be designed for any type of individualized advice. So, we will provide you with some context, excuse me, and contacts, if you will, for if you do want more of that individualized advice or you want to know more about Brian and his team. I'm going to do that first. So let's go ahead and let's just take a look at um, when you get to the login screen, right? So when you go to schwab.com, this is the page that you'll see here. And it was nice of our friends to put our National Investing Days front and center right there on the page. But I want to show you how to navigate around a little bit for all the different things that Schwab can offer for you. And I know that James and Kevin kind of took you guys all through some of the research and some of the things on schwab.com that can help you do stock research, ETF research, so on and so forth. But I want to focus a little bit more on services in this section. So let's do this. Let's go to a couple different things. We can start with advice. So if I click on advice, this is where you'll see where Brian and his team are located, Schwab Wealth Advisory. I'll click on that. And then this gives you the whole slew of different things that Brian and his team can offer, and we will go into that in more depth. But I just wanted to make sure that you knew where to locate that. A couple other things when you go to Why Schwab here. One of the things that I'm very passionate about is education. So, the Schwab coaching team, that is what we do on a daily basis, 35 hours a week, providing education for, look, traders and investors alike. And I think today is really more focused on the investor. And I'll speak a little bit, Brian, if you don't mind, about maybe some of my past here. I actually started off in the trading world. So coming out of college, I went down to Chicago, worked at the Chicago Board of Options Exchange, became a market maker, full-time trader in options. And I thought that was what I wanted to do for the rest of my life. And lo and behold, that was during the launch of kind of the internet and all the different ways that investors could do research, could trade. I mean, it just exploded in terms of all the access. And, Charles Schwab is a pioneer in providing that access and democratizing what we, as we say, not only commissions, but education. Really, I mean, that was a big step in kind of the leaps and bounds that we've seen with clients and in their competence, their confidence is having some of the access to that education. And so you can see some of that here and all the different things that we offer. But like I said, we're going to concentrate on a couple things today: wealth and investment management solutions. And then we're going to for sure concentrate on Schwab Wealth Advisory, which is Brian's group. Let me do this. Let me get back to our slide deck here, and we will move forward. All right, Brian, I'm going to start with this first slide. And you lead a team that, in my mind, really helps investors connect dots, right? I think that is and maybe you can speak to this and this, but this is my interpretation between planning, between investing, between taxes, retirement, and all the different moments that life throws at you along the way. Maybe start by sharing how Schwab Wealth Advisory supports clients from maybe that first conversation all the way through kind of the ongoing advice.
Sure. And this is sort of that ecosystem I referred to, that there's many elements of a wealth management quote plan, if you will, and interconnected elements, and different ones take on different priority at different stages of your life. It all starts with investment planning. That's by far the biggest. That's where you're going to start. That's what you're going to maintain throughout the whole journey of your wealth management through your life, and then beyond. Hopefully, as you see some of the estate planning, that you get there at the end. But it is an interconnected system. Even as you mentioned, traders, and I know we have lots of traders on the call. There's components outside of trading too that impact your financial wellness, if you will, overall. And that's what you see here. Investment planning, retirement planning is sort of a subset of investment planning, but it's both accumulation and at some point, obviously, withdrawal. And how do you sustain that withdrawal? Then you have education and family support, obviously saving for college if you happen to be in that, or as many of us are finding ourselves in the sandwich generation, that family support becomes important, that you may find yourself supporting a family member later in life. Tax planning, obviously big, depending on, what state and what bracket you're in. Taxes could take anywhere from, 15 to 40% of your gains. So that's a big component that's very important how you think about it, even at the very, very beginning.
Mhm.
How are you going to start investing? In a tax deferred account, in a taxable account. So that has a lot of importance right away. Banking and credit management. So there's the asset side of the balance sheet that we all talk about, our personal balance sheet. But there also is the liability, and how do you use lending in a smart way? How do you create liquidity? Obviously, if you're younger and you're thinking about saving for a home, how do you think about creating that liquidity for a down payment and or a mortgage? And then as you get later in life and you have assets, but maybe not as much liquidity, how do you use those assets to generate liquidity if you need it? Risk and insurance, again, as you get started, probably not quite as important, although there are certain, events that can really, really alter a person's life if it happens early on and you don't have proper risk management and or insurance coverage is basically what we're getting at there. And then lastly, estate planning. What do you want your money to mean for the next generation or a charitable cause, or, what it might do once you're gone, if that's your desire, or you could create a plan where you try to spend it all, depending on what it means. So again, you can see it's a big connected system. There's
Yeah.
cost elements, there's investing elements, there's tax elements, there's personal situation elements. So a pretty large interconnected system.
Let me ask you a follow-up question then. You've had these conversations with thousands, if not tens of thousands, investors along the way that have, sat across from you or your team. When they ask the questions, and maybe there's a myth that that they buy into initially. So, what's maybe one myth about wealth management that actually kind of holds some of these investors back from getting help sooner rather than later?
Probably the biggest, and I'll throw multiple concepts into one. One is that it's time consuming, it's
Hmm.
complicated and expensive, which prevents people from getting started. Now it can be complex, doesn't have to be complicated, but obviously this system, and you look at all those, and it can feel a little overwhelming. And that's what we see is many people are hesitant to get started because it does feel overwhelming. You look at these concepts, if you're not familiar with some of them, they can feel that way. And what I would say is the best way to overcome that, and we do this with our clients all the time. I mean, part of it is you got to create the plan, but part of the plan is you do it one step at a time. You're not going to
Yeah.
tackle all these at once. I mean, some of them will be dictated by your life stage and where you find yourself. But even then, we don't tackle them all at once.
Sure.
We, create a plan like, okay, over the next 6 months, we're going to focus on retirement planning. Over the next 6 months, maybe we'll talk about education. Okay, let's talk about estate planning and gifting and account titling. And so it doesn't have to be all or nothing. In fact, that's generally a recipe for failure if you try to tackle it all at once. So don't think it's overwhelming. Take it a step at a time. If you need the help, obviously you just mentioned the resource we have on schwab.com.
Yeah.
Get yourself a little educated. That always helps the process go smoothly. And then as you start to work and maybe seek help from others, just make sure, they're along with you and providing that education and transparency. Because again, not everybody's used to dealing with this every day. I get it. It can feel complicated, but again, it's complex, but doesn't have to be complicated if you have the right partner along the way.
Yeah, that makes sense. I mean, look, it basically sounds like your definition of wealth management does change as someone's kind of moving through their investing career. And it sounds like you and your team can help them kind of prioritize along each and every one of those steps. Let's do this. Let's move forward and take a look at another slide here. Really more structured on kind of core wealth management topics here. So, risk, retirement, investing, banking, family estate taxes. Let's start off with this. We have a slide here that looks at planners versus non-planners, right? When you see kind of a slide like this, yeah, it makes sense, but maybe kind of get into the psychology behind this, if you will, because yeah, I mean, we understand planning makes you feel better, but sometimes you got to plan, right? So, maybe kind of get through the psychology, the mental hurdles to get started.
Well, you're absolutely right. And this is, I mean, when I see this. It's like a self-fulfilling prophecy. Obviously, if you plan, you
Yeah.
feel better,
Right.
you feel more confident, you know where
Yeah.
you're going. But again, so many don't take that first step of creating that plan and understanding where it is they're going and how they're going to get there. And then if they get thrown off along the way, they don't know where to turn because the plan. I mean, so it's a roadmap. It's basically a roadmap of where you're going. And it can be as simple as, I mean, I'll use retirement as the example. Like, okay, you're going to spend X number of years in retirement. You want X amount of dollars. So you just create a present value of what that is. So now you know the bucket you have to have when you retire. You know where you are today and how long you have to get to build that bucket. And so some of it's a math equation in many ways, but we can help you. Schwab
Hmm.
has tools that you can help yourself if you want to do some of this math, but it starts to lay the groundwork for, okay, how much do I need to save? How much do I need to earn? How much do I need to let that compound? So again, think of it as a roadmap. You're going on a big journey. You got to know where you're going. If you don't know where you're going, you're going to end up somewhere you didn't expect. And so that's all this planning is. And again, the key is get started. Don't do it
Right.
all at once. It can feel overwhelming when we ask you, what do your investments look like? What does your insurance look like? How much are you saving? Have you thought about estate planning? But again, get started, start chunking them off one by one, and pretty soon the whole plan comes together.
So a follow-up question to this. Basically, when people registered for this event, they were able to ask questions, and a lot of them were specific to kind of the wealth management 101. And one of the things we continue to see is, hey, I'm in my 40s, I'm in my 50s, I'm in my 60s. Is it too late to start? Can you provide a roadmap for me at this point, or have I already missed that? How would you and your team kind of handle that question?
Never, ever, ever too late to start. Um, Regardless of what you have or how much time, you still need the map. Doesn't
Yeah.
matter. You got to have that plan. Now the later you wait, the more complicated it might
Hmm.
get because you just have less time. Um, and that's one of the keys here is creating the plan is to understand, which I think is a huge concept everybody should understand, and you should all be teaching your children the time value of money. I mean
Hmm.
that's as I mentioned that math equation. Basically, it's time value of money, and compounding in time. And if you think about, regardless of what your plan says you're saving for, whether it's education, retirement, home purchase, whatever, you sort of have three components that dictate how much you're going to end with. It's how much you save, what you're going to earn on that savings,
Hmm.
and then how long you let that compound. And that compounding piece, that's why early starts obviously better, but it's never too late to start. Because if you think about the savings, you have somewhat control over that. You can, defer some of the spending and save more, but you have a limited amount of whatever your earnings are, how much you can potentially save out of that. Your return, which I think people sometimes focus too much on, if you're in a diversified portfolio, the market's going to dictate a
Right.
huge percentage of what you can actually earn. What you do have a lot of control over, though, is the amount of time you let that compound. And that is so, so important. I'll just share some of my favorite quotes around compounding, which I'm sure many people have heard, but Albert Einstein referred to it as the eighth wonder of the world.
Hmm.
And my favorite of all time is the Ben Franklin quote about compounding, which is money makes money, and the money makes money.
Hmm.
And that's
Yeah.
exactly what happens. You earn 10%. Now that 10% is also earning whatever on top of whatever the original was. So don't hesitate to get started. It's never too late, but obviously the more time, the better to allow that compounding to take effect.
Well, clearly, just major steps below those two that you quoted. I'm going to give you a quote from the Mazzola house. So please do not assume that I'm putting myself in the same conversation as those two. But here's one thing that I say to my kids. I got a 17-year-old daughter and I have a 14-year-old son. And, believe it or not, living in a house with, with a dad who kind of does this for a living, they don't always approach me with questions around investments. And, I try to stimulate the conversation as much as possible. And to all you parents out there, please do that. Please continue to have that conversation, kind of, we just opened up recently the new teen accounts. I mean, there's a lot of ways for you to kind of get that started. And you just talked about, here's what you do control. You control time, right? I mean, imagine the potential magnitude of getting somebody started off their first job, right? Their first job, and they can put money in a Roth or a college savings account for a newborn or something like that. I mean, it's important to really start having these conversations. But here's what we say. And we talk about the difference between what I want versus what I need. And I say, look, money doesn't grow on trees. Money grows in compounding accounts. And that's exactly how I want my kids to think about it. And if there's one thing I want, kind of our viewers to take from that, and they're having their conversations with their kids, you can quote the other two first. Clearly much more important than me. But think about it in terms of how do you start that conversation, with the younger people in your lives, and I think that's important. All right, let's move forward now that I left you with that.
Hey, Joe, can I mention
Please.
just one thing about the plan too, which
Yeah.
is I talk about you don't have to do it all at once, gives you a place to start. That's what the plan does too, is it helps you
Mhm.
prioritize. Like, okay, what do I need to think about first here? Is it retirement? Is it home building? Is it,
Yeah,
college education? Is it pay off debt? Whatever it might be, it helps you establish that order of priority.
it does. Absolutely. All right, let's talk a little bit about maybe goals and asset allocation. Um, Brian, you stress defining goals before investing, and I think that's important. So for a newer investor, what's the best way to turn broad goals into practical decisions?
Well, as I sort of alluded to, creating that plan, which is somewhat of a math exercise,
Yeah.
it will lead you down the path of, how much do you want at the end, whatever that end is for, home purchase, retirement, education, whatever. And it will literally give you a range of what you need to be saving today given the time horizon you have, and we can tell you what the average amount of return you're likely to get over a length of time. So again, I don't want to sound like I'm harping, but a little bit I am. Without the
Hmm.
plan, it's hard to know, like, okay, how much
Sure.
should I be savings? And then um, it becomes very tactical and practical, which is the where. Where do I do that? Where do I save? Like, is it tax deferred? Is it taxable? Is it a college education savings account? Is it, as you mentioned, a teen account? Because I'm getting my children involved in investing. So then it starts to get very, very tactical and practical
Hmm.
of the how much. Okay, now the where and the how. And then ultimately, of course, investment selection. And okay, now that I've got all that figured out, what does my asset allocation look like? Which is basically based on what your risk tolerance or your appetite for risk looks like, plus your time horizon. That starts to get narrower and narrower down the path into, okay, what am I actually going to buy?
Yeah.
What's my ETF, mutual fund, individual stock, whatever it might be. But all that pre-work, I think, is necessary in a longer term plan. And a lot of people start on the reverse end and start buying things. But if it's not, every investment you buy should have a specific intent
Yes.
and be playing a role in your portfolio. And that's what, some of that planning and this overall wealth management concept helps you narrow down, so you know exactly why you're buying what it is you're buying and what role it plays in a portfolio. Is it about risk management, or is it about return enhancement? Is it about diversification, which is kind of risk management in itself? So that's how you start to get to the very practical and tactical steps.
So here's an interesting question. It comes from one of our registrants and says, "Hey, how do I balance needs between long-term planning and liquidity, especially in this type of market environment?"
Well, you need to have both, which I know sounds like a trite answer. But you have to, like retirement. I mean, you
Mhm.
can't be swayed by the day-to-day movements if your goal is 20, 30, 40 years out. Um, Another famous quote I'll share with you is Benjamin Graham, who wrote sort of the seminal book on investment analysis, literally. But he had a famous quote, which is, the stock market in the short term is a voting machine.
It is.
Like, we vote on what we like day in and day out.
Yep.
But over the long term, it's a weighing machine. it will weigh your wealth. So you need to think about, what do I need to accomplish in the long term versus what's happening day to day, which is a lot of volatility. And you can trade on that volatility if you want, but in many cases for your long-term money, you should be ignoring that short-term volatility and looking at, what do 5-year, 10-year, 15, 20-year returns look like? Because that's how
Hmm.
long you're going to be investing. However, as you mentioned, there's always a need for liquidity. And a liquidity fund, we would argue, which is generally 3 to 6 months of living expenses. If
Hmm.
you're not in retirement, if you're in retirement, you stretch that out, and have 12 to 24 months of living expenses. Why is that? Because we don't know what life's going to throw at us, and
Yep.
we might need a sudden home repair or a car purchase or help a family member or whatever, and we don't want to be doing that on a downturn for the day or the quarter or a year or in the middle of a bear market. You don't want to be accessing your investments, because basically you're selling at a low, which is the opposite of what we want to do, which is obviously buy low, sell high.
Right.
And that's what that liquidity, it provides that cushion, so you're not forced into liquidations of long-term investments, for a short-term need.
Yeah. No, that makes sense. And look, it's hard in this environment. And I'll speak to some of my trader friends out there. I mentioned that was my background, but one of the things that I kind of recognize, and here's something you see on the trading floor all the time. You see people that um, are fairly talented at making money in the short term, but don't know kind of how to balance that in the long term, right? They don't understand estate planning needs. They don't understand insurance needs. They don't understand things like, tax considerations, all these different things. And I really do think that having, a healthy balance of the two makes a ton of sense. So even if you are somebody who says, look, I am clearly more self-directed. I'm definitely more tactical in what I do, but I need a little bit more of a strategic approach. I mean, I fall into that category. So I think what you're saying makes a ton of sense to me. All right.
We have, if I could just step
Sure.
in for a minute, Joe, because we have many clients in that same situation, and it's a little bit of mental accounting. I get it, but mental accounting can be very helpful. And this
Hmm.
is one of those occasions where I think it can be very helpful. There's nothing wrong with separating your money into two buckets, and you
Yeah.
might have your trading shorter term money, and then you might have your longer term, more stable money. And we have many clients like that who do it for different reasons. One, they
Hmm.
have, an interest, and they want to be active in trading, and others who say, the rest of my family doesn't have that same level of interest, so I better have some, longer term wealth management money over here just in case. And so there's many reasons, and I get it. It's all one big pool of money at the end of the day. But this is where mental accounting
Yep.
can be helpful by separating that out into buckets. We do a bucketing approach that we can talk about in retirement that's similar, but you could do it also early on, and different buckets of money for different goals or different levels of interest and involvement.
Yep. Look, I'll bring it back to younger generation as well too. So there's another conversation that we have, and and this is a valid question that you get from a lot of younger investors. That they say, what if I want to do something with that now, right? Like yes, I see the retirement calculator. I see a 7% or 8% or 9% return compounded over 30, 40 years. And look, I'm looking forward to retiring at, 60, 65, whatever that might be, and having that big chunk makes a ton of sense. But look, I still got things I need to do now. And I think that bucket strategy makes a ton of sense. So once again, the way that I kind of look at it is I say, you're going to have multiple accounts. You're going to have, your retirement accounts. You're going to have that account for, your first home, and you're going to have that account for things that you want to do in the next few years. But only certain percentages go in each bucket, and we're going to give, that longer term horizon, that retirement account, the bigger chunk of those assets. And these are, once again, kind of go back to those money management conversations and kind of that wealth management 101. All
which
right.
which we have a lot of material on. We have
Yeah.
a whole program called Money Wise, where we try to
Hmm.
teach multiple, younger generations about money. I'm a little bit of a research and a math geek, so I get it. It doesn't work for everybody, but just literally walking through an example of what that compounding can mean versus
Yep.
deferring that gratification, which I get it. Hey, in today's society, deferred gratification is not popular. because you can swipe your phone 100 times in 30 seconds and get some level of gratification, which is, in my own personal opinion, a little bit hollow. But anyway, just an example, 10%, assume you can earn 10%. You start with $1,000. You start at 25, you save it till you're 65. $45,000 that turns into, slightly more than 45,000, compounded from 25 to 65. If you wait because you want to do that spending, that instant gratification, you need to spend, you're not going to save, you'll wait till you get a little older. So you start saving when you're 35. That same $1,000 put away when you're 35, fast forward to 65, is 17,000, less than half. I mean, it just shows you the power, even just waiting. That was only a quarter of the whole time period that you waited, but it has massive impact when you start to factor in compounding in those out years. So hopefully that would open somebody's eyes. But again, goes back to the plan. That's why you need a plan. Who knows about $1,000? Let's look at your own personal situation and what it might mean.
Yeah, absolutely. All right, a few more. Let's talk about our suite of managed portfolio options. And as we think about this, it highlights kind of, monitoring, adapting portfolios over time. Why is, in your opinion, why is wealth management not just a set it and forget it type of approach?
Well, you referred to the market volatility. So
Yeah, sure.
we know things change over time, both for individuals personally. I mean, we all know, life throws curveballs at us and things change, and we have kids or grandkids or purchases that come up that need to be taken care of. So your own personal situation changes over time. That's one of the first questions we ask on every consultation we have with the client. Has anything changed in your life since we last talked? And most of the time, I'm like, oh, geez, you got to ask that question over and over and over. But it's like 1 or 2 out of every 10 times somebody says, oh, yeah, I hadn't told you yet about, X, Y, or Z that happened in my life that now I need liquidity or I'm going to have to defer something. So your own life changes, as we all know. But just, well, I guess not just as important. That's more important than anything that happens in the market. But the market changes.
Yep.
And you need to adapt to that. And probably one of the best examples I have is rebalancing a portfolio. You got to manage your portfolio over time. Because the market changes. And the best example is the market goes up. If you start with a 60% allocation, because you said my risk allows me 60% stocks, because I know what that looks like as a portfolio. I got 60% stocks, 40% bonds. That's what I'm comfortable with. Well, we all know the market goes up more than it goes down. If you let that sit in a portfolio over time, and I mean, if you look at pre-2000, before the crash, if you look at pre-2007, before the Great Recession, if you look at pre-COVID bear market, which was relatively short but still impactful, and you took the 10 years before that and you had started with a 60%, in almost every one of those situations, your portfolio of stocks had grown from 70 to 80%. That means when they go down, you're losing a lot more than you told us originally you wanted to lose because of your risk profile.
Yep.
So because the market is dynamic, you should be dynamic. And you should be, as those equities go up, trimming them back every once in a while, getting back to your comfort level, your risk profile. So every year you go through, you say, oh, what's gone up? Sell a little bit of that. What's gone down? Put it into that, which is not intuitive. And a lot of people don't practice that. But that's why you need to adjust the portfolio, because your life changes and the market changes, and you don't want your risks to get out of alignment with your personal situation or the market. You determine your risk profile. Don't let the market determine your risk profile by its movements and how it affects your portfolio. You want to have control over that.
Yeah, there's also really good tools on Schwab.com where you can do kind of a portfolio performance. You can do, your allocation. You can say, I'm moderate risk, or willing to take on more risk, and basically it'll kind of show you percentages in terms of sectors and international versus U.S. and equities versus fixed income, and it'll let you know when you've kind of come out of alignment with that. And as you mentioned, it's not necessarily the decisions that you're making that can get you out of that alignment. It's just the market. It's the market volatility. Here's the other thing too. You might You might say, well, I have an allocation of maybe 25% to technology, and you get these big run-ups, as James and Kevin were mentioning in the preceding session, where some of the stocks that you own have had, 30, 40, 50, 60% gains just in the last few months alone, and now they represent pretty large chunks of the portfolio, or maybe technology is becoming a little bit too big of a part of your portfolio in terms of your risk and your risk tolerance. It makes sense to kind of keep an eye on that, or work with partners like you and your team to help you kind of keep an eye on that. And I would say this. I think maybe when you think about the standard in our industry, we talk about quarterly or semi-annual or annual rebalancing. I would look at it more as rebalance based upon your life or portfolio changes, or the market changes, is kind of what we were just talking about there. If things have moved around, right? If you've seen big swings in multiple directions, here's the other thing: market goes down, that can be an opportunity as well too. You talked about the liquidity, looking for opportunities in some beaten up sectors that you think have the ability to rally. We've seen that multiple times over the past year, where there's been these kind of redirections or reallocations into different sectors, and having some of that liquidity available can help you participate when the market does turn things over into different directions. So I think that's a really interesting point.
Two thoughts, if I could, Joe. Sorry.
Sure.
One is what you've just mentioned, which is a recent phenomenon which everybody should be aware of, which is, it's generally a good thing we have these Mag 7 stocks, these technology stocks, and it goes beyond that. But we have a relatively narrow market if you go back over the last 5 to 6 years. And those positions have grown to be, in many, we see this like every day, the concentration level of some of those individual names has grown beyond what most people would have signed up for from a risk perspective.
Yep.
But then this is where wealth management comes in. But they're like, I don't want to sell. I'm going to have to pay taxes. Okay, I get that. There's other ways to unwind it. There's ways to think through it. But don't let that risk sit on the table.
Yep.
The market has grown. Those stocks have grown. That is a very good thing. I get it. Taxes, nobody wants to pay any more than they have to. But that's a sign that you've made money. And there are smart ways to think about that through gifting or some other strategies we have and can teach you about how you unwind some of those positions. Because we all know the history. You and I have been in this business a long time. You go back to 2000 through 2002. And I'm not saying these companies are going to do that. Everybody thinks they're going to change the world when they're at highs. But you look at Pets.com and Webvan, and these are companies that had, hundreds of millions and billion-dollar valuations that are gone. They're no longer in existence. Fast forward to 2007, 2008. Oh, we'll never have a period like that again. It was the Great Recession. Bear Stearns, Lehman Brothers. These companies are literally $1 billion worth of valuations and gone. And so I'm not saying that's going to happen, but if your risk has grown and you have a concentration level, you should definitely think about getting that risk under control. And again, there are many ways to do that. There's outright sell, pay the taxes, move on. But there's other ways to think through, again, gifting, and some sort of programmatic selling. You could use options to protect your downside while you're implementing some of these plans. But just again, as I said, don't let the market dictate what's going on. And then my final thought is, as you look at this wheel, and it shows you all the different asset classes, and you're like, geez, why do I have some of those asset classes? If you're doing things right, there will always be something you love too much in your portfolio, which means you probably ought to be trimming it back. And there will always be something you hate.
Right.
And I think about when we got to the end of 2024, people said, why am I holding international? It hasn't returned, it's half of what the US, less than half of what the US returned. And then you fast forward to 25, and then it's double what the US did, broad-based US versus broad-based international. It's like, oh, you hated it back then. Now you love it. That means you're doing something right. If there's something you don't like in your portfolio and you're questioning why you still own it, that means you're probably properly diversified.
No, 100%. And even when we look at the equity diversification quilt that I know that you guys have at the branches, and everybody sees those. One of the things that we've noticed, especially over the last couple of years, is just the month by month change amongst the sectors. It's such a rapid rollover, such a rapid turnover that it kind of preaches that diversification, because you don't know what's going to be the sector leader the next month. A perfect example was, heading into the Iran conflict, everybody had talked about wanting hard assets, right? They came up with all these new acronyms for the hard assets, and you want to be in commodities, you want to be in industrials, you want to be in materials, all these different things. And then got this supply shock, right, from crude oil, and then people started to roll into energy and utilities very quickly. And then, we hit a ceasefire, and then they started to pull back a little bit. So it's hard sometimes to see the forest beyond the trees, right? When all of the noise is going on. But what I think is really good about what you and your team do is you kind of help you help your investors just kind of slow it down, look for the longer picture, and kind of help them provide that roadmap to get there. And let's do this. Let's take a look at one more slide, and then we'll get a couple questions in here from before. This is really almost like that roadmap, if you will, right? The advice spectrum. So Schwab, they have an advice spectrum. I think the idea, and you clarify for me if I'm wrong, it's to meet investors where they are, right? How should someone think about where they are or where they're going to be? So maybe start with this. Like, how do you think about your fit today?
Well, that's a very good point, and I think, obviously I'm a bit biased. I work for this company and have for a long time, but that was
Mhm.
sort of the vision Chuck had, um, which even when he lowered commissions back on May 1st, 1975, it was how do we help clients where they're at? Back
Yeah.
then, people said, I don't want to pay for research necessarily in the form of a commission on a stock I want to buy. I just want to buy the stock. I know what I want to buy. Can you just give it to me at a good value? And I think we've carried that forward as investors that have asked for more and more when it comes to research and investments. And you're absolutely right. Let's meet the client where they're at in their particular journey. That can mean, as you see on the left side, just do it all on your own. If you feel confident and comfortable and you want to get educated and do things on your own, we have many, many options
Mhm.
where you can go in. We have, a huge mutual fund, ETF marketplace. Obviously, you can buy any number of individual stocks, options. So you can do it on your own. We're happy with that. Little occasional guidance, or there's ways that we can do it all for you. If you want to hire us or hire a professional money manager to invest that for you or help with your wealth, or we can help with you, do it with you. And that's generally what Schwab Wealth Advisory does. My program is we want our clients to be involved. We want to help educate them. We want to be along for the ride with them. And one of the most important elements we find in that approach um, is that money and finances are charged with emotion and often baggage from whatever your potential family situation might have been, how you grew up, what your
Mhm.
grandparents experienced. And so sometimes you just need that sounding board.
Yeah.
Like, I'm freaked out and I'm worried, and here's why I'm worried. And we can say, look, at least any of my advisors can say, look, I work with over 100 families just like you in your situation. And here's what they're thinking. Here's how I'm helping them. I've been through this, over decades. Here's my experience viewpoint of this. And sometimes it can take the emotion out of it, because that's often many investors' worst enemy is their own emotions. We are not wired necessarily to be great investors. We're wired to avoid risk
Mhm.
as humans, which is good, helps you survive. But in investing, you have to take risk. That's how you get a return. And so again, we have the spectrum, whether you want to do it on your own, be heavily involved, do your own research, all the way up through, doing it for you or doing it with you. We can offer at Schwab.
All right, I'm gonna pull forward a couple questions that we got. Like I said, for people who registered in advance, they filled out their questions, and so want to grab a couple of these. All right, this is one question that says, I'm 55, just beginning my investment journey. What are the most important rules I should know starting out, and what common mistakes do late starters make that I should avoid?
Um, I would say diversification, risk
Hmm.
control. I mean, the risk control is another way of saying diversification. That's how you control risk in investing, is your level of diversification, and another term, asset allocation, how much you're going to have in stocks, bonds. So that's the first one. Second one is cost. Make sure you understand the cost of what you're paying. If you're 55 and just getting started, you have a limited time, so you want to make sure that you're not overpaying for the investments you're buying or the help you're getting. Make sure it's transparent. You should understand. We're big believers. You should understand what's going on in your portfolio. And if the advisor can't explain it to you, or you don't understand, get educated or make them explain it to you, or go to someone else who can. And probably the biggest mistake for those getting started a little later in life is trying to make up for lost time
Yep.
by taking on more risk.
Yeah, I
That
agree.
is a recipe for disaster. Don't take on more risk because you have shorter time. You have savings elements, and don't forget you have a broad spectrum. People often, forget. Oh, they might have a pension plan from way back when that they could draw on. They have an annuity that they haven't looked at in a long time. You obviously have Social Security, which is going to be a big stream of income for many as you approach the retirement eligible age, and that offsets income you need from your portfolio. So again, it's that big picture. Make sure you don't take too much risk. Make sure you're understanding the bigger picture of where all those sources of income might be, and then what your portfolio needs to generate.
Makes a ton of sense. Brian, thank you. Thanks so much for your time. I really appreciate all your insights, and thanks to all of you for tuning in. I hope you enjoyed the session. Look, just want to celebrate National Investing Day with you. Thank you for our clients, and thank you, to those of you who might be just learning a little bit more about Charles Schwab here today. I want to make sure you stick around, right? We have sessions throughout the entire day, but following up in the next few minutes will be our next session, and that's how to vet stocks for long-term investments. They're actually going to help you from a fundamental and a technical approach. So you'll learn a little bit more about figuring out stocks in terms of kind of breaking them apart and looking at things like earnings and income statements and revenue and cash flow. But you'll also look at it to see from a technical perspective to see whether or not there's some volume and price movement behind these moves. So I think that'll be something that you'll find of interest, and that will be hosted by Rachel Deshelle and Casey McCurdy. So make sure you stick around for that. Once again, Brian, thank you for your insights, and thank you to all of you for tuning in. Stick around, there'll be more.